Hi everybody, I hope you're doing well. So today we're going to keep working on adjusting entries in the second stage of our accounting cycle. The reference text that we're using for this is Kimmel, Weygandt Kieso's Financial and Managerial Accounting. The specific chapter is chapter number 3, and we'll be looking at problem set B's problem 3-4B today. So essentially the question states that a review of the Ledger of Han Company at December 31st, 2014 produces the following data pertaining to the preparation of annual adjusting entries. So we understand that this is the entire year of adjusting entries. There are 4 particular entries that we're looking at here: prepaid insurance, unearned rent revenue, notes payable, and salaries and wages payable. The instructions are to prepare the adjusting entries at December 31st, 2014. So let's take a look at the first entry. Now I will be working out the mathematics in front of you in Excel as we go through this, because that calculation is critical in this particular case. So in the first adjusting entry, we have that the company has separate insurance policies on its building and its motor vehicles, as any company should. Policy B4564 on the building was purchased on April 1st, 2013 for $6,000. The policy has a term of 3 years. And policy A2958 on the vehicles was purchased on January 1st, 2014 for $4,800. This policy has a term of 2 years. Now we're going to divide these two policies separately. So let's look at the building policy. I'm just going to call it the building policy over here. Okay, the building insurance, and this is just for the sake of calculation that we're doing this. And so if it was purchased for $6,000 and it has a term of 3 years, that means 36 months is where we will divide it into. So that means that each month the building insurance will decrease or be utilized by $166.67. Now the critical factor here is that because it was purchased on April 1st, 2013, it's already been adjusted partially in 2013. We are looking at a review for 2014. So we want to make sure that we are able to factor in 1 year of adjustment over here. So we're going to go ahead and multiply that by 12. Let me in fact do it a little bit differently. I'm going to enter this amount here. So we'll take the 167, we're going to multiply that by 12, because from January 2014 until December 31st, 2014, you have incurred 1 year of essentially utilizing that insurance policy. So for the building, you will have insurance utilized of $2,000. Then on the other hand, your policy for the vehicles was purchased on January 1st, 2014. So your vehicle insurance is going to be, again, the total amount was $4,800, and this will be divided, because it has a term of 2 years, it'll be divided by 24. So we're doing it on a monthly basis, right? And because an entire year has passed, so we'll simply take that number and we'll multiply that by 12 to find out, because it was purchased on January 1st, 2014, we were able to utilize it for that entire year. So the vehicle insurance will have a value of $2,400. Now from the get-go, we also understand that insurance itself, when it is adjusted, has an entry of an expense being incurred against an asset being utilized. So this will be insurance expense debit to prepaid insurance credit. Okay, now that prepaid insurance, in this particular case, we know that it is a clubbed value or a clubbed account, because it has this value of $9,300 over here, and it falls under the account of prepaid insurance. And so we will simply club it together over here. The amount that is the total will be the sum of $2,000 and $2,400. That means we'll be debiting $4,400 and crediting $4,400 for insurance utilization across this entire year. There's our first entry. If you're ever a little doubtful, go ahead and check out that number on the side, and there you go, insurance expense for $4,400. We're right on track. Okay, so entry number 2. Entry number 2 here is unearned rent revenue of $429,000. The company began subleasing office space in its new building on November 1st. Okay, November 1st just means, 2 months ago. At December 31st, the company had the following rental contracts that are paid in full for the entire term of the lease. I'm going to go ahead and move this down just a little bit so that we can do the working in front of it. Now, you have two different types of contracts. And so your November 1st contract is a 9-month lease for a monthly rent of $5,000, and you have 5 leases of this kind. And this is your prepayment. That means you received this. You've received 9 months worth of rent from 5 of your customers or 5 of your clients. So to do this particular calculation, from this 9 month, from the first contract, from November till December 31st, 2 months have passed. So we'll take the amount of time that has passed, we'll multiply that by the number of by the monthly rent, that's $5,000, and we'll multiply that by the total number of leases, and this allows us to determine how much of the unearned rent revenue we've actually been able to earn. And this is from the first contract. So we've earned $50,000 of revenue from the first contract. From the second contract, the start date is December 1st. That means that we've only utilized this for 1 month. And we have monthly rent of $8,500. So 1 month multiplied by the monthly rent multiplied by the number of leases. This is going to be our second calculation. And so our total rent earned is going to be $50,000 plus $34,000, and that gives us $84,000. This is the number that we're interested in. This is our calculation. Now, because this is unearned rent revenue, the adjustment here is going to be to decrease the liability of unearned rent revenue and to recognize the revenue generated. And so that is unearned rent revenue is to be debited, and against this, rent revenue is to be credited, and the amount is going to be $84,000. Okay, now let's move on to the third. In the third entry, notes payable of $120,000. This balance consists of a note for 9 months at an annual interest rate of 9% dated November 1st. Now, whenever we have a notes payable, that means that we're going to be adjusting for the interest. And we already know that interest, according to our formula, so interest is equal to PRT, right? Now, based on this, what we want to do is we want to calculate the total amount of interest that we owe at the end of this particular time period. And because we got this note on November 1st, that time factor is critical. Okay, so the principal amount that we owe is notes payable is $120,000. So we've got principal $120,000. The rate that they've given us here is 9%. So we'll simply put in 9%. And if you're working with decimals, that's 0.09. And we're going to multiply that by the time that has passed. And from November 1st till December 31st, 2 months have passed. And because the rate is applied at an annual rate, so we'll do 2 divided by 12. And so the amount of money that we owe in the form of interest is $1,800. That is the number that we are going to incorporate in our adjusting entry. Because this is an adjustment of interest, so it's an expense and a liability. We've incurred an expense and it gives rise to a liability, and the entry is going to be interest expense debited to interest payable credited, and the amount is going to be $1,800 to $1,800. Now let's look at the fourth entry. And the fourth entry, salaries and wages payable are 0. So there are 8 salaried employees. Salaries are paid every Friday for the current week. 5 employees receive a salary of $640 each per week, and 3 employees earn $500 each per week. Assume December 31st is a Wednesday. Employees do not work weekends. All employees work the last 3 days of December. Now, because the salary is associated for the 5 working days, we can actually calculate a daily wage for a certain group of employees. And in this particular case, what we want to do is we want to calculate, we want to take the total weekly salary. We're going to multiply that by the number of days worked divided by total days for which that salary is allocated. If December 31st is a Wednesday, that's 3 days that they've worked out of 5 days. And how many employees do we have at this wage of 640? We have 5 employees. We'll multiply that. And this is the amount of money that we owe to the first group of employees. For the second group of employees, using the same formula, we'll take our wage for the week, we'll multiply that by the number of days worked out of the week, 3 days worked out of 5, and the number of employees that were present for those days. It's all 3 employees within this particular bracket. And so we owe $900 to our second group of employees. And so the total that we owe is going to be $1,920 plus $900. That's $2,820. That is the number of interest to us. And because this is an adjustment of salaries that we owe, the adjustment is again is an expense that arises and a liability that arises. And so we'll have salaries and wages expense debit to salaries and wages, my apologies, salaries and wages payable. And so the amount is $2,820 and $2,820. Okay, so these are 4 adjusting entries, and just to cross-check your references or cross-check your numbers, that's $4,400 for insurance, rent revenue is $84,000, interest expense is $1,800, and salaries and wages are $2,820. And so you know you're right on point. Don't forget to like and subscribe. Stay up to date with our accounting and finance updates. If you have any questions, please comment and let us know if you need help with any additional resources. Thank you very much.